Want to know what a REIT is, how it works, and how it can help you make more money? In this video, I'm going to break down everything involved with REITs. What's up, you guys? It's Josh Tavares from TNR Wealth Strategies, certified legacy real estate investment advisor. Here in our channel, we focus on all things personal finance and real estate investing. Remember to hit that like button, hit that subscribe button, and even jiggle the notification bell so you can get updates on our newly uploaded content. Want to know how you can own a piece of commercial, multifamily, or industrial real estate without needing a large down payment or dealing with tenants? In this video, I'm going to break down how a REIT works and how it can make you some more money. REITs are a straightforward business model. Essentially, you're owning a piece of real estate, which could be an apartment building, industrial, commercial, renting it out to your tenants, receiving rent, and based on those cash flows, those will get distributed on to your shareholders. For a company to qualify as a REIT, there's some provisions that a company needs to follow with most security exchanges. Essentially, owning real estate long-term, generating income from it, and being able to pay out remaining profits, such as cash flow, onto shareholders. So of course, with certain exchanges, there are going to be some different provisions. So I highly recommend that you look into, if you decide to open up your own REIT, look into some of the different provisions within the securities exchange in which is in your jurisdiction. Also, you must have investment in real estate, either cash or treasuries, to be considered a REIT. And here are some other things as well. Typically, you want to give back about nearly 75% of your income back to shareholders in the form of dividends, which is typically paid out quarterly and sometimes monthly. In your first year, you should normally have at least about 100 shares available for purchase. Typically, you shouldn't have more than 50% of your portfolio from five shareholders or less within an existing tax year, especially within your first year of existence. Comment down below if you've already invested into a REIT. If so, let me know the type, the return, all that good stuff. So remember, comment down below. Here are a list of 7 different REIT types that you can invest your money into. Equity REITs. Equity REIT is the most common form of a REIT, and essentially the enterprise itself owns, manages, and operates revenue generating properties in which they have tenants, usually paying down the mortgage, paying the rents, cash flowing, and like we said before, the company go about distributing a lot of the added cash flow in the form of dividends to their shareholders. Next one are mortgage REITs. Mortgage loans are essentially loaning out mortgages out to real estate investors, operators, and then with that revenue through the interest, able to pay off a percentage of that off to your shareholders and be able to continue to invest that percentage back into the business while also sending off a lot of that back into your investors. So that's essentially, in a nutshell, what a mortgage REIT is. Essentially a loan that's used for real estate investors. They charge a fairly high interest rate in which a percentage of that will go off to the shareholders and the rest will continue to be invested back in the business. The next one is a hybrid REIT. A hybrid REIT is a mix of the equity and mortgage REIT, essentially having them both together into one portfolio in which they can, over time, have more of the mortgage REITs if they like, diversify, or even have more of the equity REIT, whatever works well with their portfolio, balancing out and still paying out dividends off to their shareholders. So it's a really good way to get the best of both worlds and really reduce the risks. Publicly traded REITs. Publicly traded REITs are REITs in which you can purchase through the stock exchange through a stock brokerage or through a broker, and where you can own a piece of that real estate that company has, like I said before, whether it be industrial, multifamily, as well as commercial. With this form, it tends to be the lowest cost, the most shares available, typically lower dividend structure. However, it ends up being a really good way to enter the market without needing to have, tens of thousands of dollars to purchase one share like you would with something more like a private REIT, which we're going to talk about soon. Public non-traded REITs. Public non-traded REITs still need to follow the procedures within the security stock exchange, in which is in your region. You can essentially purchase these stocks or these shares through the enterprise itself. You can't use a stock brokerage account or a broker to go about it, but there are going to be some questionnaires and finding out a little bit more about if you can qualify, if this makes sense for the company to have you on as a shareholder, if you have the funds available. So it's still a very good investment. However, it's not as liquid as something like the previous one, meaning that you can't just sell your shares and then be done with it. you would need someone to essentially buy those shares from you, and you'd have to actually find a buyer. You couldn't just click the sell button and then voila, off your hands, no longer have to worry about that exchange. Private REITs. Private REITs are very much like the non-public REITs. The only thing is there's no securities exchange involvement whatsoever. So essentially you don't have to worry about what the security stock exchange worries about. So essentially you can go about being part of a list of potential investors. So some more of a waiting list in which the company would of course look over your portfolio and look over your credentials and see if you're a good fit and if you have the funds available to transact. So very similar to the last one. However, there's absolutely no rules you have to abide by through the security stock exchange. Having REITs are a great investment. However, there's some pros and cons you need to look into. And let's get into that. On the plus side, REITs many times can be very liquid, in which you can buy, sell, many times a lot easier than the sense of owning physical real estate. With REITs, you don't have to have, like I said earlier, a large down payment, deal with tenants, worry about zoning, worry about closing costs. Just put your funds in there, and a lot of those management fees will go about finding the property, transacting on the property with the funds, managing it, making sure that everything is done appropriately. So it's one of the really good signs, or one of the really good things involved with owning a REIT. REITs are a really good investment in terms of the reduced risks of not having to worry about owning physical real estate, but also some of the different risks involved with owning stocks of, Coca-Cola perhaps, where in any moment you could be up 2% and then be down 5% the following day, or with bonds where you're very limited in terms of your typical return, where with a REIT you're usually getting the increase in capital appreciation of the shares itself, as well as the dividends, which is really, really nice to help beat and hedge past inflation. On the downside, you don't receive as much benefit with a REIT as you would with owning physical real estate. With physical real estate, there's 6 ways that you can win: through cash flow, mortgage paydown, asset appreciation, the control of the investment, leveraging, and tax advantages. Where with a REIT, you're only getting so much of those. And essentially with a REIT, about a lion's share of the income generated goes back to shareholders, and very little after, of course, assimilated with tax, goes back into the business to reinvest. So those are a couple of things that to really look into when it comes to investing into a REIT. Another thing is dividends are taxed as regular income. So if you're generating a pretty good income and you're receiving dividends, let's say quarterly, the government will take that on as regular income. So that could affect your tax holdings. So be definitely very careful with that. Speak to your accountant if you're generating a high volume of dividends, quarterly, monthly, or whatever it may be. If you're someone who is a little bit lower in terms of the amount of income it provides you, if it's like $50, $100 every couple of months, may not be a big deal. However, if you're a high income earner and you're receiving maybe a couple $1,000s quarterly, that could really be the difference of you having to pay back a lot more money. So I would definitely do your research, speak to your accountant, and figure out if owning a REIT and having it as income will really ding you in the tax department. Very important to also look at the management team of a REIT, know about their experience, know about how they get compensated. Are they getting a salary where it doesn't matter the performance, they're still going to be generating income from themselves in a salary standpoint? Or is it also based on the performance? See, if it's based on the performance aspect, they're more likely to care more for the property and for as the organization as a whole, and invest back into it and make the right management decisions to help the organization grow and help build appreciation and value for those properties. If it's salary based, they might just do the status quo, the bare minimum, and that's not really good enough, as many shareholders might be really disappointed with the lack of value added, because at the end of the day, you want to have your money work for you. And if you're going to have a CEO or a executive committee that's not really all in the game of enhancing the value of the real estate as well as the company in which it holds in, then you may need to look at taking your money someplace else, or essentially those board members need to be removed and have to have a new different structure in terms of more of a performance-based structure instead of a salary-based. There you have it. Now you know what a REIT is, how it works, and how it can make you more money. Question: are you interested in lowering your transportation costs? If so, click on the link below. I've included the link, which is one of my previous videos, in which transportation takes up nearly 33% of many people's income. So highly recommend you check that out. Click on the link below. Also, if you want to join a community of like-minded investors, head over to our TNR Wealth Strategies Facebook page where I provide real estate investing and personal finance topics, so get in the community and get involved. If you like this video, remember to hit that like button, hit that subscribe button, and even jiggle the notification bell so you can get updates on our newly uploaded content. Want to grow your net worth and wealth? I recommend clicking up here, down here to learn more on different strategies and tactics that you can use to enhance your well-being.